The Bank of Canada shocked the market this week with a 25 basis point rate hike. But more importantly, in this video, we are going to be covering what is next. Is the Bank of Canada going to continue to increase the rates? We'll be taking a look at some of the areas that they're watching in order to make these decisions. We'll take a look at some trends over history of what they've done in cycles when they have been increasing the rates. And then we'll give at the end what I believe to be the most important metric as to why and how they are making the decision of the interest rates. But if this is your first time here, my name's Nick and welcome to Ways to Wealth. Higher for longer. This is something that we've heard out of Tiff Macklem in the past, and we heard it most recently from Paul Beaudry in a speech this week after the most recent rate hike. So let's read a little bit as to why they made the decision to go 25 basis points higher. So the article goes on to read, the accumulation of evidence across a range of economic indicators suggests that excess demand in the Canadian economy is more persistent than they thought. This increases the risk that the decline in inflation could stall. So the fact of the matter is that although rates have increased dramatically over the past year and a half, people are still spending and there's still demand in the marketplace, although the cost of goods have increased. So with that being said, they still had to take into consideration another rate hike. And let's not forget, the Bank of Canada's target is to keep inflation between 2 to 3%. That is what they believe to be a healthy economy, and we are not there yet, and this is something that they're trying to do in order to get into that range. So the question still remains, are there more rate hikes on deck? We'll take a look at what Earl Davis has to say about that. When the Bank of Canada starts hiking, it's not just one hike, it's multiple hikes. So because they hiked today, I do expect to see one, if not two more coming down the line before they pause again. Davis had previously predicted that rates would reach 6% by the end of the year, but has since shifted to 5 or 5.5%. He goes on to say that there's probably another 25 basis points coming, maybe not in July, but possibly in September if inflation doesn't come down, and it doesn't seem like it is. Now that's definitely an interesting point where the Bank of Canada doesn't just hike once. So let's take this time to go back and take a look through history. So we'll start off by taking a look at the most recent year, and we can definitely see, and we've all definitely felt the impacts of the rates going from about 0.5% or almost zero all the way up to almost 5%. Now let's take it back and look at the last time that we did raise rates, and that was in between the 2017 to 2020 period. And he's definitely right. They definitely do raise the rates in small chunks, but there are gaps here where they did miss policy announcement periods, and they did hold over, a couple months before raising again. So it's definitely something to consider. And we all remember the sharp drop during the pandemic where we did bring rates down to a quarter basis point. So let's bring that back even further. The time before that they did raise rates was in between that 2005 to 2006 period, and you can see here that it was a straight shot up. Now they did pause for a long time before raising before 2007, but there are periods here where they do raise a couple and then hold, raise a couple and hold, and then drop. When we take a look through history, it's very hard to tell if the Bank of Canada does work in a sequence in terms of multiple rate hikes, or if they do one or two or one and stop. We can definitely see that there's a multitude of different trends in here. So in order to predict whether there's going to be a next rate hike, I don't think can be done through history. Things are a little bit different in this current environment. So it is something to take into consideration, but I think we can do a little bit more homework to figure out what's truly going to happen in the future. Now, just a couple days after the interest rate decision, we got some employment numbers here in Canada, and it's actually shocking to see that we're on a little bit of an uptrend in terms of the unemployment number. Now, the unemployment number has definitely been very strong, and one of the reasons that the Bank of Canada has decided to start increasing the rates, especially over the past couple years with the measures that they've taken in terms of printing money and making sure that companies are protected and they have a lot of cash flow and a lot of liquidity. But we are starting to see that trend increase. But with that being said, the Bank of Canada should have had a peek into these numbers, but that begs the question of how could you increase the rates knowing that more people are losing their jobs? I think the market expected about 21,000 in job gains. We actually lost about 17,000 jobs, so a little bit of a big swing there in my opinion. But with that being said, the Bank of Canada probably had this information, but they still decided to go forward with the rate hike. Obviously, this decision is making a lot of people with variable rate mortgages very upset, and something that they have definitely taken into consideration. They did a report that they released about 3 or 4 weeks ago, which we'll dive into a little bit now to give you a little bit of an understanding of their thought process as to why they think they can continue to raise rates. So the Bank of Canada does estimate that people who renew their loans over the next few years will see a spike of 20 to 40% in their payments. The bulk of borrowers have not felt the sting of higher interest rates because their mortgage have fixed monthly payments. And the bank said that by 2026, nearly all borrowers will have to renew their mortgages, resulting in higher payments. So with this information, how can we continue to raise rates knowing that eventually, and maybe not even so right now, people haven't really felt the brunt of it? Yes, variable, but those that are fixed are yet to feel the pain. How can we continue to go higher? In light of higher borrowing costs, the Bank of Canada is more concerned than it was last year about the ability for households to service their debt. The central bank said that more households are expected to face financial pressure in the coming years as mortgages are renewed. With that being said, we continue to say, how can we continue to raise rates without crippling the housing market? Carolyn Rogers did address these concerns. Given that the job market has remained robust and unemployment is low, the bank said higher mortgage payments should be manageable for most households. However, the bank said that the impact will be more significant for some households. So the Bank of Canada does know that the impact will eventually hit into the housing market, but as of right now, that is not their main concern. Now, what is their main concern, you ask? Well, let's dive into that. And realistically, this should come to no surprise because what they have been mentioning, one of the things that they are watching, trying to get into their range of 2 to 3% is the inflation rate. That is their main target right now. And of the most recent print, we did see that uptrend start to continue again. So we're taking a look at the inflation rate here in Canada, and what we can notice is this uptrend here in the most recent report. This is a concern for them. They cannot let inflation continue to be persistent. It is not healthy for the Canadian economy in the long run. They need to nip this in the butt. We did see with the interest rate pause over the past couple of months that the housing market has started to shoot up again. We've started to see, certain things, cost of goods, the core inflation rate continue to stay high and even increase for that matter. This is a problem for them. We've spoke about it in the past. They think that inflation will still be around the 3% mark even till next summer. And this is something that they're trying to get ahead of, something that they're trying to make sure that we don't hurt the economy in the long run. Will there be short-term pain? Yes, unfortunately there is. But until this inflation rate gets down to that neutral range between 2 to 3%, we will continue to see interest rates higher for longer. And we've talked about this for a super long time. And even with the housing report that they came out with, most of the people won't feel the impact, or let's say everybody won't feel the impact until 2026. There are people that are impacted now, but the brunt of the pain or all of it is definitely happening within the next couple of years. So let's just put that into our back pocket. Higher for longer. Interest rates are not going down. Will there be another rate increase? Well, it all depends on what the CPI print is going to be. So the next one does come out on June 27th, so make sure you're paying attention to that. That's when the inflation rate for Canada is going to come. And then the next Bank of Canada interest rate decision is going to be on July the 12th. So make sure that you're watching the inflation to have an understanding of what's going to happen in the next policy rate announcement. If you like this video, we cover the Bank of Canada all the time. Check out a few of the other videos that I've done in the past to get an understanding of what's going on in the Canadian economy, and let me know your thoughts about what's going on with the bank interest rate down below. I hope you all have a great week in the markets. Happy investing.